The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Investors want to party like it's 1995, but will the Fed let them? Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Bonnie Quinney. We are counting you down to the closing bell. So let's have a look at where we stand, because earlier it looked like we might actually hit another intraday record. We did hit it, and now we've backed right off when it comes to the S&P 500. We probably won't make a 39th record of the year today on a closing level basis, but we are at 56.25, so within spitting distance, and obviously everybody's waiting for the Fed decision tomorrow. Will it be 50? Will it be 25? The Nasdaq 100 also off its highs. We're basically at session lows for the Nasdaq 100. We did see some movement in Treasury yields, of course, after the retail sales data. We're at 358 now, up about 3 basis points. That was about 5 basis points earlier on. And look at the retailers. If there's any area that's doing well today, it's consumer discretionary after those retail sales surprised to the upside.
Yeah, some interesting price action today, of course, on a day where Jay Powell and the Fed did indeed kick off that latest of the two-day policy meeting. That was this morning on time. And while we still have about 23 hours to go before we know the outcome, the markets appear to be primed for a proverbial soft landing akin to that pirouette Alan Greenspan pulled back in '94 when he doubled rates to 6% to curb inflation, and then in turn in '95 cut rates back down to 5.25% in just 6 months without plunging the economy into a recession. And like nearly 3 decades ago, investors are betting on a revival of undervalued stocks once that easing cycle does indeed begin. ETFs focus on stocks that trade below what they're worth. They've raked in about $7 billion so far in September. You compare that to growth stock ETFs, which are nursing outflows. You see that reflected in a 4th day of outperformance for the Russell 2000 versus the S&P 500. And that's boosting investor sentiment for the first time since June. At least that's according to the latest global survey by Bank of America, which says based on cash levels, equity allocation, and growth expectations, fund managers see a 79% chance, Bonnie, of that soft landing.
Well, market implied odds of a 50 basis point cut, Romaine, have jumped just since the PPI last week. Remember, it was just a few days ago that we got that PPI data that maybe put a little bit of doubt into investors' minds. Well, right now, market implied odds of a 50 basis point cut tomorrow, 55%. So definitely non-zero chance of it. But don't forget, there's a whole array of options in between, right? We could also have a 25 basis point cut with maybe a descent, maybe even 2 descents, so that would be very unusual. But that might be considered a hawkish cut, for example. So will it be the tortoise? Will it be the hare? And, you know, what exactly will we see from the news conference tomorrow? Investors, and we certainly can't wait, Romaine.
All right, well, let's pose that question to our first guest as we kick you off to the close here on this Fed Eve. Tuesday afternoon was Sophia Drossos, economist and strategist at Point72, joining us here in Studio 2. All right, Sophia, let's just get the obvious question out of the way. Do you think we're going to get 25 basis points or 50 tomorrow?
I'm looking for 25 tomorrow. So 25, in my view, is in line with the most recent Fed official communication before the blackout period started. And 25 seems to me a nice gradual way of starting easing cycles, which is historically the way the Fed likes to do things, particularly when the data are beginning to show that the economy's got a lot of forward momentum. So the Fed may have met its goal and feeling a little bit more confident on the inflation side. That warrants cutting, but perhaps not the urgency to start with 50s.
What do you make of some of the recent economic data we've gotten outside of just the jobs report? I mean, we've had retail sales numbers, we've had housing statistics, we've had a lot of metrics that seem to suggest that the economy is doing okay. It's not teetering on the edge, not necessarily going gangbusters, but it's there, right? I mean, people are spending, the economy is humming. Is that not right?
Yeah, absolutely. Yeah. The economy is slowing. We wanted it to slow. It was growing twice of its trend growth rate last year. So the whole point of tightening monetary policy was to try and slow things down and reduce the growth pace a little bit. But we don't have a recessionary impulse. And I think that's very important and what a lot of people might be missing. While we are seeing some loosening in the labor market, that's really coming from increased supply. It's not coming from companies firing people. And in fact, corporate margins.
Increased supply as more people coming in.
Yeah, exactly. We're seeing a lot more people coming into the labor force, and that is helping, I think, to mediate the inflationary impetus from the labor market. But what I think is important to keep an eye on is corporate profits and corporate margins remain near their historic highs. The consumer is doing very well, bolstered by falling inflation and declining gasoline prices.
Sophia, how big of a disappointment will it be tomorrow if we don't get that 50 basis point cut? I mean, we do have Nick Timiraos in the Wall Street Journal saying it's going to be a close call. We had an FT article saying the same thing. And investors are pricing in at least one 50 basis point cut in the next 3 meetings.
Well, about a week and a half ago, they were only pricing in 25 basis points, and the market and growth-sensitive sectors and assets seem to be doing very well under those conditions. So there might be a knee-jerk uncertainty that if the Fed doesn't quite meet the 50 basis point hurdle. But I think the bigger picture is the Fed would only be restraining itself and cutting 25 because the underlying economy is quite strong. So net-net, I still think that's a very positive message for U.S. assets.
Why is the Atlanta Fed GDP now forecast at 2.5% for the third quarter?
Well, it was just revised up to 3% after today's data, and it reflects the strength I think we're seeing, particularly in consumption. So we are seeing a pickup in confidence on the business side as well as on the consumer side. And as I mentioned, some of these other factors I think are helping consumption with prices coming down, gasoline prices in particular. And I think on the corporate side, perhaps there's some relief that they do see the Fed cuts in the trajectory. And in that sense, 25 or 50 probably matters less than the direction of travel, as Chair Powell put it.
And it gets to the whole point, too, is that the actual release might be sort of a non-event. But I'm curious about the press conference and what Jay Powell is going to try to communicate to this market. Is there any sort of advantage to him basically saying that, yes, we are going to give the market effectively what they've priced in, 75, 100 basis points over the next few months? Or should he kind of keep his cards closer to his chest?
Well, you know, historically, at this juncture, there's a lot of uncertainty with how things are going to pan out. And so that might limit the pre-commitment that the central bank is able to offer. And in fact, that's what we've seen other central banks do as they've started their easing cycles, whether it's the Bank of Canada or the ECB or the Bank of England. They've started with the rate cuts. They've talked about how inflation is on a trajectory to come back to target, but they've left the exact tactics of the rate path a little bit unknown because there isn't quite that much certainty. And as we saw in the most recent CPI report, things can be a little bit choppy, even if you think you're on a path back towards a 2% inflation target.
So what does that mean for investors? Should they start positioning around a meaningful drop in rates over the next few months?
Well, I think we've already seen a pretty decent drop in rates, and I think investors need to focus a bit more on the growth outlook. What the Fed is doing is still very preemptive. You talked about 1995. That's the only other time in recent history the Fed's been able to stick the soft landing. And that was an environment where the Fed acted preemptively and early, as we think they are doing now. And that should just mean that there is less recession risk going forward. So net-net, that tends to be very good for risky assets, and equities and credit should continue to do well in that environment.
All right, great conversation, Sophia. Pleased to have you here on the program. Sophia Drossos over at Point 72, kicking us off to the close as we really evaluate the potential implications of that easing cycle. And of course, that is going to have a big impact on real estate. Some folks saying that the negative headlines around real estate are no reason to scale back. And in fact, the opportunities are there. We're going to get a sector update from Morgan Stanley Real Estate Investing co-CEO Lauren Hochfelder.
Plus, chart-topping recording artist Will.I.Am singing a slightly different tune these days. He's pressing play on a slew of new AI ventures. He's going to join us later to share details.
But before that, Bonnie, we got to go back to the real estate beat. But this time, we're actually going to drilling down into the interior of those homes. Renovation experts Drew and Jonathan Scott, who I'm told are contractually obligated to always appear together, the Property Brothers, they'll be joining the big program a little bit later. Stick around. All that and more coming up in a bit. This is The Close on Bloomberg.
All eyes on the real estate market ahead of tomorrow's Fed decision. Our next guest writes, quote, "While the headlines around real estate continue to be negative, we think it is a really attractive time to invest." Joining us now is Lauren Hochfelder, co-CEO of Morgan Stanley Real Estate Investing. Lauren, does it matter to you and your day-to-day work and what you're looking at if the Fed moves 25 or 50 basis points tomorrow?
So great to have you frame it that way, because I think the short answer is no. We try not to get too distracted by these massive market mood swings and volatility as to is it 25, is it 50? Rates coming in is really good for real estate, but day to day isn't going to make an impact.
It's better for some real estate than other types of real estate, though, right? And I know that you had been bullish on things like warehouses, and coming out of the pandemic, you know, a lot of people were bullish. Why still bullish on warehouses?
Sure. So over the past, 10 plus years, we've been really bullish on warehouses for a host of reasons, principally e-commerce growth, right? As you and I have bought more and more of our goods online and wanted it faster and faster, that's been really good for industrial values. But today there's really a second mega driver, which is supply chain changes, the rerouting, the rerouting of the global supply chain. We're doing a U-turn on globalization, and companies learn the hard way about putting all their eggs in one basket. They are diversifying where they manufacture their goods and how they get those goods to the end consumer. Both of those create additional and shifting demand for industrial real estate.
And this is what I love about what you guys do, because you kind of focus a little bit more on kind of these bigger thematic trends, I guess, of where the economy is going. I think we all know where things are going, but how do you pick? And because that's got to be a little bit harder, right? I mean, to really pick the winners. So when you're looking, so let's just take something like warehouses and that supply chains. How do you know geographically where to go? Like, what's the process that you put into that?
So you start with what the driver is, right? So when the principal driver was e-commerce, we wanted to be in those large distribution facilities in the port markets. We wanted to be an infill industrial close to the consumers. Those are still attractive, but you're seeing a shift. So for example, historically, Southern California was among the strongest industrial markets in the world. It's where all the goods came from China into the U.S. to the U.S. consumer. Today, now that we're seeing a diversification of manufacturing away from China, some of the other port markets are doing much better. So, for example, the East Coast ports. So there's that. Then the shift towards onshoring or nearshoring of manufacturing. That's benefiting markets that, involved in those. So southern border markets, for example, as goods come from Mexico.
Another big thematic issue is sort of the dearth, if you will, of housing, at least housing in the right places here. How are you investing in that? I mean, what's your approach? Are you focused on single family, multifamily, what?
Yeah. So, there is a severe housing shortage, obviously a big issue. But again, we go back to what's driving the demand. And if you look at the U.S., there are two large age cohorts that are driving the demand. It is millennials who are growing up and growing out, and boomers who are growing older. So look at what they need. Millennials need more space. Boomers need more services. Housing with increased healthcare services. So we've been very actively investing in senior housing in particular. It got really dislocated in COVID, and so you can get an attractive entry point. But we know the number of 80-year-olds in this country, seniors are 1 in 5 people in this population, and that's growing both nominally and as a percentage.
We had this great story out today that Dartmouth is investing $500 million to try and solve its own little housing shortage, right? I mean, but that's not a nothing number. That's huge. Would that be a type of project that you would ever be interested in, even if we, don't see it replicated across the country? But we probably will.
Yeah, so I think the ultimate answer to the housing crisis we're facing is supply. And so we need to address supply by bringing new housing of all sorts, whether it's that or others. And I think importantly, while we know we're undersupplied, it's such a localized thing. And so you see certain markets that are seeing these massive pockets of oversupply. Developers always develop to the rearview mirror. So some of those markets that were COVID darlings are now massively oversupplied in the short term, and other markets really need more.
All right, Lauren, now it's time for that question that I'm sure you're getting tired of answering, and that is about office real estate here. I mean, things did not fall off the cliff to the extent that I think some people thought, but we all know, we've seen the numbers, not everybody's back in the office. There's this idea that longer term, we're not going back to that 100% or whatever it was occupancy rate that we had pre-pandemic. How is that investable right now?
Well, here's what's interesting. So, you've heard me say before, there's a wide bifurcation in office performance, the best versus the rest. But here's what I'd say, that trophy quality office space not only is inoculated from some of these headwinds you're describing, it's actually benefiting from, because you've seen massive consolidation of demand into the best of the best. To be clear, it's a pretty narrow lane, but for those best office assets, they're becoming almost an oasis in an office desert. And so even take San Francisco, that city is still sub 50% office utilization, vacancy approaching 40%, that's stunning. And yet in our office assets there, we're getting all-time high rents. So it really speaks to some sweet spots.
Lauren, you mentioned earlier how you don't really take too much notice of the vagaries of, the interest rate moves on a monthly basis. But over time, surely it will impact your portfolio massively. What will the cycle bring the rate down to?
So this is the question. I'd say, look, ultimately, we don't think that rates are returning to pre-COVID levels. And that's really important for real estate, among other reasons, because it means that the massive cap rate compression or multiple expansion that we saw in real estate post the GFC, we don't think real estate investors can rely upon that this time around, which means two things. It means you need to invest in real estate that can have cash flow growth. And how do you do that? You focus on the mega trends we've been talking about, and you own real estate that you can improve. It's not buy and hold, it's buy and change.
All right, well said. Lauren, always great to talk to you. And by the way, take a tour around our Class A building here. So
we got a good deal.
They were giving out peach pie a little bit earlier.
Oh,
that's how Mike
like
keeps us all happy. Lauren Hochfelder, co-CEO of Morgan Stanley Real Estate Investing. When we come back after the break here, we're going to talk about shopping and specifically Shopify. One analyst over at Redburn Atlantic, he says now's the time to buy that stock. We're going to talk to him and about the growth trends that he's seen as part of our top calls. That's coming up next. This is The Close on Bloomberg. All right, let's get a view from the sell side. Top calls, big movers on the back of analyst recommendations. And we start off today with AppLovin. UBS upgrading shares of the software company to buy from neutral. The analysts citing improved visibility into medium-term revenue growth and a, quote, supportive valuation. AppLovin's improved relative return on ad spend versus competing channels, also rarely seen in the digital ad space, and could support 20 to 30% software revenue growth from gaming alone. The analyst telling investors that in a research notes and bumping the price target to 145 from 100. The shares getting a bump up by about 6% here on the day. Next up, let's take a look at Hewlett-Packard Enterprise, getting a bump up to buy from neutral over at Bank of America. The firm citing a number of catalysts for the stock, including significant cost cuts, a cyclical recovery in core markets, and revenue synergies from that pending acquisition of Juniper Networks. The price target going up to 24 from 21. The share price going up 5% to $18 and change. Finally, let's end things on Shopify. Redburn Atlantic analyst Dominic Ball assuming coverage of the e-commerce platform with a buy rating and a $99 price target. Ball says Shopify is a prime beneficiary of growth in U.S. social e-commerce. He cites easy-to-use platforms and social media integrations as being one of those catalysts. The share is getting a modest boost on the day, up by about 0.8%. And those are some of our top calls. We do want to stick with that last one, and pleased to say that the man behind it joins us now. Dominic Ball, fintech research analyst over at Redburn Atlantic, a company owned by Rothschild and Company. All right, let's get right to it. We all know Shopify, Dominic. We know that they've had their ups and downs here. What gives you the confidence right now going forward that this is indeed a buy stock?
100%. Well, first of all, thank you very much for having me on. It's a pleasure to be here. So we upgraded Shopify from a neutral to a buy, really based off two factors. One that you've mentioned on social e-commerce in the US. We think this is going to propel the US e-commerce market to much larger than the market anticipates. We actually forecast it to grow from 60 billion in volumes in 2023 to 350 billion by 2028. We think this the catalyst is TikTok Shop, and then the response from the Western social media platform to this really puts into the forefront to the US consumer of social e-commerce. The next part of it, the second reason why we are very bullish on Shopify, is its ability to increasingly take market share of this larger market. If you look at micro, SMB, low and mid-market merchants, Shopify has the deepest and the breadth of the ecosystem, the best breadth and depth of ecosystem, which is very unparalleled against other competitors. So this ecosystem makes it very difficult for other competitors to penetrate the Shopify moat.
And your price target is above $99 for Shopify. I am curious, though, since you mentioned TikTok and TikTok shopping, what's the challenge if TikTok is indeed banned or in some way banned or has to sort of divest from ByteDance in the United States?
Yeah, so that's a great question. So it's going through the court right now. If TikTok is not necessarily going to be banned, but if it has to be sold away from ByteDance. I would say, looking at the US election coming up, both Kamala and Trump don't actually want to ban the platform. But let's say it was sold to someone else or another competitor, I think the strategy is unlikely to be changed because it's been very successful as it is. And also a domino effect has started to occur anyway. TikTok Shop has come about being very successful very quickly, and we've already started to see others like YouTube try and copy them.
Well, this seems to be kind of the power, though, of Shopify, and I'm curious about the potential integration. I mean, talk up to me a little bit about Shop Pay, the way that they've integrated that into a lot of sites, and how an expansion in the social media space would enhance that or not.
For sure. So Shop Pay, the best way to think about that is it's a button which is very easy to use. You press it once, and then another time, and it's very low friction. It's very popular between the younger demographic of consumers as well. Those that typically are the ones that actually purchase through social e-commerce. If you look at the average age of a TikTok user, it's 24. YouTube is slightly older, but the ones that are really propping up the growth of social e-commerce are the younger consumers, and they're the ones that represent both in the Shop Pay button. It's been proven by both internal Shopify studies and external that there's a structurally higher conversion rate. So when you press that button, more times people make a payment versus when you enter credit or debit card details.
All right, Dominic, great stuff. Dominic Ball over at Redburn over there in London, a company owned by Rothschild and Company. An initiation today, picking up coverage, a buy rating on Shopify. You use Shopify?
You know, I don't choose to use it. And I have to say, when it comes up and it's a purchase, it's done and I'm relieved. But at the same time, there are a lot of purchases that I make that I probably wouldn't if I did have to go through that extra step.
Yeah, and I think that Shop Pay is really just kind of the thing. I mean, and it's easier than some of the other versions like Google Pay and Amazon. It just seems a little more seamless. I don't know how they pull that off, but it is a lot more seamless. All right, when we come back here, we just can't talk enough about AI, and neither can the musician Will.I.Am. He's launching a one-of-a-kind media platform that aims to give listeners that extra boom, boom, pow. That conversation coming up next on Bloomberg. Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Vonnie Quinn, and we are for sure off our lows. But that NASDAQ, Romaine, it's eking out a tiny, tiny gain still.
Yeah, it's been an interesting price action today. We actually had a strong rally earlier in the day. In fact, the S&P at one point traded above its closing record high, but it's actually now dipped back into the red. And this is all everyone trying to front run what we think we're going to learn tomorrow out of Jay Powell and the Fed.
Well, I'm not sure. What do we think we're going to learn? 25, 50? What do you actually? Let's get your forecast on the table right now.
How about 33? Okay. I don't know. I know nothing, but what I do know is that investors really are sort of banking on getting a little bit more clarity about the pace of this easing cycle, and a lot of it gets to this idea too of how it connects with valuations. We talk about a market that has really rallied hard on the back of big tech, and more importantly, on the back of a lot of AI names, whether it's NVIDIA, Microsoft, and a few others. And a big question here as to just how much life is left in that trade. Of course, a lot of people jumping into the AI space, some with some whack ideas and some with some creative ones, including our next guest. 7-time Grammy winner Will.I.Am is using artificial intelligence to amplify the listening experience. He's launching a new feature to his FYI.AI platform called Radio FYI. It's an interactive tool that allows listeners to chat and personalize a radio interface. So let's get it started with the man of the hour. Joining us right now is Will.I.Am. Of course, you know him as the founder of the Black Eyed Peas music group. How you doing, Will? Great to have you here. Love the glasses.
Good to be here.
Talk to me about how the radio listening experience, or really just the music listening experience, changes with something like Radio FYI.
Yeah, if you think about radio, radio changed my life. Right now, there's millions of cars being deployed and being made. And if you think about, like, as we speak, somebody's putting an FM, AM antenna into a car. because people still listen to radio. And radio hasn't been innovated since satellite radio. And so now with our architecture, we're able to allow the listener to engage with the presentation. It's no longer a one-way street, or sometimes half a street when you're able to call into a station. This radio architecture allows for one to many, so millions of conversations at the same time during the same segment, for as deep of a conversational tree that you want to take it towards. So you can turn the radio station to a politics station, a sports station. You can ask any question at any time about the song, about current events, breaking news. It's truly transformational.
Well, that's what I'm curious about. I mean, I think we're around the same age. So I grew up at a time when you did have a little bit more interaction with radio DJs, whether it's calling in or just being able to really connect with them in a way that I think has been lost, at least with normal terrestrial radio here. How is this going to compete, though, with the Spotifys and the streaming platforms and the social media platforms that I think have grabbed the attention, certainly in my household, of my kids?
So, okay. We are assuming that radio is the same as streaming just because it's playing music, when in actuality, that's not what radio is. As much as radio is about music, it's more about local, what's happening in your community. And I don't know the last time I listened to Spotify and I figured out, when it's raining or what's going on or what just broke. That's not Spotify. Spotify is, the world's jukebox. Radio is what's happening in my community that's going to impact my life as I'm going from point A to point B, or when you're at home listening to the radio. And so what we wanted to do is take that concept and expand it 1,000-fold to where a person can not only learn about what's happening locally, but globally at will, whenever it is they want to talk about it, however they want to twist and turn their interests and turn it into meaningful action. And we're here at Dreamforce. We're about to put a sales portal on radio. Last time I checked, I have music on Spotify. When people were listening to our songs on Spotify, they can't ask the song what I meant by that lyric. And with this architecture, it also allows for artists to dream up and make amazing stations for deeper engagement. But just because it's music does not mean it's the same experience. Spotify is not the same as a concert. A concert's not the same as radio, and radio is not the same as listening to music at home back in the day when we had CDs and record players. It's never going to get back to that. It's going to go to something even deeper, more engagement, and that's what we aim to do with radio.fyi.
It feels a little Blade Runner 2049-ish, Will. Is that what it's going to be like, a sort of personalized DJ, and maybe you change that DJ every day?
No, if you want to change DJ every day, well, it's not really a DJ, it's the entire experience. It's the DJ, it's the segments, it's the subject matter. For example, you guys report the news all the time. There's listeners that are like, what are they talking about on that segment? So what do? They take to Reddit, they take to Twitter, and they find out more, they research. But now when something is presented, I could just say, hey, what do you mean by that?
Yeah.
Can you explain that more? How does that affect me? How does that affect my community? Right? So this concept of a one-way push, that's not what tomorrow looks like. And it's not sci-fi like Blade Runner or some far off distant time. This is right now.
Yeah, for sure. Yeah, exactly. How are you going to monetize it? Will people pay for this experience?
We'll monetize it with new ad units. So with every new innovation comes new ways to monetize. So right now, you're going to break to commercial. And that commercial is going to be, maybe people paid attention to the commercial. Maybe it translated to some sale, right? In this case, if you're interested in that, you will ask like, tell me more about this product. Mm-hmm. And now that the system is your sales agent. So everything is going to change with, this type of architecture. And I'm so happy that, we had the insight and the skills and the talent to be able to materialize this ideation and deploy.
Why do you think it's taken us so long to get here? I mean, I was looking at the title of your Dreamforce speech, the dawn of intelligent media. I mean, on the surface, it makes a lot of sense. But I would assume there's a cost associated with this, and obviously just a reticence among legacy media to embrace anything new. But why have it taken us so long to sort of get to this point?
It took us this long to get to the point, and thank God, salute all the folks at the that wrote that Transformer paper. Attention is everything over at Google, all that Google research, and thank you, Sam Altman and the OpenAI team for implementing, the research of that paper to create GPT, and the T in GPT stands for the Transformer. Mm-hmm. So that revolution really gave us this catapult moment that we're experiencing here. But let's look at my industry, the other hat that I wore, where I entered the space from, and that's the world of music. The record industry created a whole new type of music. It's the reason why there's classical music. But when classical music was classical music, folks that were making it were not like, yo, I'm making classical music. It wasn't classical. It just was music. Mm-hmm. And then when the record industry came, they had to differentiate this style of music making and music experience from that style of music making and that musical experience, to the point where they deem that and call that classical music. And we're going to see the same thing for this intersection and this renaissance that we're going to experience now. That's going to be, unfortunately, the past.
Yeah.
Recorded music is the past. And it hurts my heart, but it also excites me, because now it's time for the dreamers. It's time for the innovators to dream what is the new experience. Yeah. What's the new way of songwriting? What's the new way of song listening? So you mean to tell me with AI that we're going to mimic how we used to do music? Well, AI is going to do a better job of that.
Yeah. Well, it's
going to be a great mimicker. But right now, it's not the dreamer.
Yeah.
AI is not dreaming new things up from nowhere. That's our neural network. That's what we do. So creators will always be needed in this space. Mm-hmm. And I try to push myself to be that innovator, creator around the tools, putting teams together to ideate and materialize ideations.
All right, Will. Well, this is an exciting time we live in, and an exciting product from one of the great creative minds, of course, in the music and, quite frankly, in the tech space as well. Our thanks there to Will.I.Am, of course, the founder and CEO of FYI.AI, new product, Radio FYI, hitting just now. All right, when we come back, we're going to shift our focus to the AI juggernaut, or at least one of them, and that's Microsoft. It's our stock of the hour, and it's up next. This is Bloomberg. All right, well, apparently the end of an era for Steve Cohen, the legendary trader. We are learning right now, crossing the Bloomberg terminal, that Steve Cohen has officially stepped away from the trading floor at the company that he runs, Point72 Asset Management. He's still staying on in a management role. He still will remain co-CIO. But according to Bloomberg reporting, as well as an emailed statement that Bloomberg reporters did obtain, Steve Cohen will be stepping away from the trading floor. Of course, Bonnie, he has had a very colorful history. Of course, ran afoul of regulators, couldn't manage other people's money, but of course, resurfaced with Point72, a reimagining of that, managing his own funds, and obviously building that into quite the powerhouse.
He might have more time now to spend on the Mets, of course, being owner of the Mets as well. But of course, it is a diverse range of strategies employed at Point72, so no single trader, including Cohen himself, might be material really to the overall effort of Point72. That said, there are $35 billion in assets under management, a huge amount of money.
Yeah, we should point out he is 68 years old, and according to that statement, they said that he will focus on driving the firm's growth and mentoring and developing talent.
Would be nice to be one of those talents that he is mentoring and developing, Romain. Meantime, let's take a look at how these markets are faring now. We're just about 10 minutes from the close. We are seeing the S&P 500 recover ever so slightly. It was down. It's also been up today, so it's a very topsy-turvy day before the FOMC. Pretty much unchanged, 56.28. Definitely not going to make a 39th record today. We can see the equal weight index doing a little bit better, and it, in fact, is at a record. And if you look at the two-year yield, very sensitive to Fed moves, we're at 3.59 now, up about 4 basis points. The dollar index continues to be weak. We'll see how that changes tomorrow.
All right, just about 8 minutes until we get to those closing bells. Richard Bernstein, CEO and CIO at Richard Bernstein Advisors, joining us right now. He's not stepping back because there's a lot going on this week here, of course, with the big Fed meeting. But before we get to that, I actually want to start out, Rich, with the broadening of this rally that we've seen here, at least by my metrics here. We're looking at a fourth straight day where we've seen the Russell outperform. We had the S&P equal weight index hit a record high yesterday here, ahead of the SPX here. Does that bode well for the market?
You know, Romain, I think it's certainly, anytime you see breadth broaden, that's healthy for the market overall, right? I mean, a narrowing market generally means that fundamentals are deteriorating, fewer and fewer companies are growing, and that's obviously a more adverse environment. So anytime you see the market broadening, it says that profits growth is broadening, which is better for the overall economy, and I would say creates a much healthier stock market for sure.
That gets us to the question, though. I mean, how is the economy, Richard? I mean, what are people banking on here?
So, Romain, I think you want to differentiate a little between the economy and corporate profits. The economy is healthy. We could argue whether it's slowing or not. You know, I mean, GDP now came out today, I think right spot on 3%. So it's hard to say the economy is imploding or weakening or there's an imminent recession or anything like that. But we could argue about how strong or weak the economy is. Corporate profits, on the other hand, are really starting to accelerate. And that's why you're seeing the broadening of the market from your earlier question, is because now more and more companies are growing. I mean, we're at a point now where there's over 150 companies in the S&P that have earnings growth of 25% or more, and only one of the Mag 7 would pass that screen. So you can see what's going on here. There's a real fundamental reason for the broadening of the market.
After that pullback that we saw, though, for some of those companies, those large cap growth companies, Richard, we did see people like Goldman Sachs coming out and saying, look, buy the dips. These stories are still valid.
Well, I think, Bonnie, I think it's a question of whether one wants to be a trader or an investor. And I'm certainly not a trader. It's very difficult I think, to make a judgment on a short-term call like that. But from an investment point of view, I think what's starting to happen now is that you're seeing more companies with more growth that are cheaper. So if you can get more growth at a cheaper price, why wouldn't you do that? And that's why you're seeing what's going on in the market now.
Would you be somebody who would be looking very closely at value stocks right now, for example? It feels like, we've been promising that value is going to sort of pay off for, I don't know, a decade or more. Right.
So I don't know whether one has to say value per se, but, my argument has been for quite some time that the market was becoming a seesaw. 7 stocks, everything else in the world. And I don't think we have to get too sexy about what we want the other side of the world to look like. We just want to be on the other side of that seesaw. And so if we start getting caught up in, is it value, is it growth, is it cyclicals, is it not? I think you're going to do fine in a portfolio as long as you're not in those 7 stocks. I think we're going to see a kind of recalibration of the entire equity market.
This gets us now, of course, to the Fed meeting, and really that broader and what we probably are banking on is a long easing cycle here that are going to take rates from 5+% to who knows how low here. Now, historically, this has usually been good for stocks in the short term. You tend to see rallies as these easing cycles start here. How much confidence, though, do you have in the trajectory of what the Fed is about to embark on and the effect on the markets?
Romain, I think there is a real monkey wrench in this easing cycle that people haven't considered, and that is that profits are accelerating. Normally, when the Fed is cutting rates, profits are decelerating. It's very, very unusual to find a situation where the Fed is cutting rates and profits are accelerating. And so I think a lot of the historical analyses that people are doing are probably flawed because they're not looking at that how we're about to get more liquidity into an accelerating profit cycle. I would argue that's very, very good for cyclical stocks and this broadening that we were just talking about, because the Fed is now going to add fuel to the fire of an accelerating profit cycle.
So, Richard, though, has everyone sort of front run this already? Because, I mean, a lot of those sectors you're talking about, we've seen some pretty strong rallies already in those.
Maybe. I mean, I'm not sure I would say front run, but there's always this story, about buy the rumor, sell the fact type thing. And if the Fed doesn't do 50 basis points tomorrow, doesn't cut 50 basis points tomorrow, you could see a negative reaction in the market and all that kind of stuff. But I think as we stretch this out and we look at, a month, 2 months, 3 months, 6 months, if the Fed is still on this easing bent, which maybe we could argue about, maybe they won't be, but if they are still in an easing mode, I think that's going to be really good for the cyclical side of the stock market.
Richard, the Atlanta Fed GDP Now forecast revised upwards today to almost 3% thanks to that retail sales data. How can that be? How can the economy be so strong given that we are restrictive? And Fed officials have been saying we're very restrictive.
So Bonnie, your last part there is the interesting part where you said where Fed officials say they're being so restrictive. If you look at the Bloomberg Financial Conditions Index, since we're on Bloomberg here, if you look at the Bloomberg Financial Conditions Index, it actually shows that financial conditions are pretty easy. We know that credit spreads are narrow. We know that private debt is having no trouble raising capital, right? So where exactly is this tightening of credit that is so damaging to the economy that the Fed feels they have to ease, and a lot of people think they should do 50 basis points? Rather, what it looks like is the Fed is about to cut rates into an already easy environment, judging by the Bloomberg Financial Conditions Index. So I think again, this is going to add fuel to the fire. It's a very unusual situation that we're seeing here.
And then finally, Richard, in terms of bonds, would you be still at the front end or would you be avoiding it completely?
Yeah, so we actually are a little worried about the back end of the curve right now. We've seen a big rally, in the 10-year and the 30-year and the 20-year, largely because people believe that the economy is weakening. And now the Fed, as I said, is cutting rates into what could be an accelerating profit cycle. We think we're at the low end of that range for the 10-year, and the 10-year yield will probably back up. So we've recently shortened the duration of a lot of our portfolios. And we're very willing to stay at the short end. In fact, we're very willing to take credit risk at the short end of the curve because we see profitability revving up over the next, 6 to 9 months.
All right, Rich, always a great conversation. Richard Bernstein, we got to leave it there. CEO and CIO at Richard Bernstein Advisors, helping us count you down to those closing bells. Less than a minute to go here. Viney, he was, of course, talking about yields here, or 2-year right now, the most interest rate sensitive part of it, Fed rate sensitive of it. 3.6 right now.
And it's interesting because we did see that disinversion there just a few days ago, right? I mean, conditions have changed very much since just last week, right, Romain?
Yeah, and I think the market's still trying to figure this out. The whole debate over 25.50, it really goes a lot deeper than that. You really saw that in the price action today with a strong open for most stocks here. That drifted lower right around lunchtime here, though you did see a bid come into this market right around the close as the clapping begins here on this Tuesday afternoon. Fed decision eve. The Dow Jones Industrial Average at the moment is down about 6 points. Of course, we have to wait for these numbers to settle, but I'm just going to call it now. We're basically talking about a relatively unchanged day for the Dow. Similar story for the S&P 500, which is up about 2 points. Again, relatively unchanged on the day on a percentage basis. The NASDAQ composite up about 0.2%. But here's your outperformer here, and this gets to what Richard was talking about. The cyclical names, the rate-sensitive names. Your Russell 2000 up 0.7% here on the day. S&P 400 mid-caps up 0.5%. Dow Transports, Vani, up 1.
And of course, we haven't really been talking about commodities, but commodities had a big impact on the price action today, because if you take a look into the S&P 500, you'll see that oil's gain helped the energy sector be the best performer today. We're up 1.4% in terms of energy. Earlier, the best performer was consumer discretionary. Those companies have pared their gains now at the end of the session to about 0.6 of 1%. But you can see where the action was today. It was primarily thanks to retail sales before the FOMC and bets on energy. And of course, WTI crude at 71.31 a barrel, still extraordinarily cheap.
Yeah, it'll be interesting to see how that pie chart changes tomorrow, right around 2 to 2:30 p.m. in Washington. Meanwhile, at 4 p.m. here in New York, Bailey Lipschultz, senior equities reporter, and Amy Orr, equity capital markets reporter here at Bloomberg, joining us to break down some of the individual movers on the day. Hello to both of you here. And we'll start off with the gainers because you look like you're ready to go, Bailey.
Some stocks trading higher, Romaine, even though not much is going on ahead of the Fed. A little bit of companies with some news. We talked yesterday after the bell about Intel, best performer in the Dow this coming after news of a partnership with Amazon. You throw in Amazon chips and AI in a headline, and you're going to get the stock to get a bid. It's a bit of kind of a headline bingo, if you will. Stock, though, up 11% over the last 3 sessions, getting a bit of positive momentum. Still one of the worst performers in the S&P 500, still down more than 50%. But it does seem like either shorts are covering their bets or people are maybe getting a bit more optimistic on the chip maker.
Yeah, a big deal with that Amazon Web Services deal.
Yeah, a big move there. And then also looking at a company like Hawaiian Holdings, this coming after the DOT.
That's the punch?
That's not the punch, though they fly planes. I don't know.
Okay. All right.
Do you ever fly to Hawaii?
I've never been to Hawaii.
Oh, man. Well, coming from California, it was more accessible, I guess. But DOT.
Hey, you know how long that flight is
I know.
from New
Well,
York?
you might as well go to Europe in half the time at that point. DOT blessing, according to Bloomberg, the Alaska-Hawaiian merger this coming after months
Another state
of issues.
I've never been to.
Another. I haven't been to Alaska.
I just learned yesterday, literally, that they are the only 2 states in the nation that NATO is not obliged to defend should anything happen. Did you know that?
I did not.
Alaska and Hawaii are now part of this whole agreement.
Okay, so they're on their own, is what you're saying. Okay.
I will say Alaska's...
Maybe they need to band together more.
Alaska's really far, though. I know that's kind of stating the obvious. But this coming, again, after the DOT blessing that deal. So that was at $18 a share. Hawaiian Holdings closing at $18. That $1.9 billion deal had been kind of working its way through for the last few months. One final gainer, Teladoc Health, up 12% today. This coming after Jefferies touted a return to growth for their BetterHelp web traffic. Though, Romaine, the kicker, this is after 12 consecutive months of year-over-year decline. The stock is still down more than 95% from a 2021 peak. Top 5 holder, though, Kathy Wood. So maybe that ARC fallout. But again, up 12%.
I forgot about her.
No comment there. I'm not going to forecast the future if Kathy isn't. But Bailey, you're way too happy. We've got to get to Amy because there are stocks on the downside as well. Stocks that had some nice sell-offs today.
Yeah, definitely. And we started off with NVIDIA as well, because the stronger than expected retail sales is actually kind of putting pressure on the equities market. And people were expecting 50 basis point kind of decrease, but now it might be just down to 25. So people were slightly disappointed and still kind of debating between the two. So NVIDIA, it's down like 1%. And also falling 4% or so is Essentia, which is a consulting company.
Yeah, I saw the story.
Yeah, so essentially it's telling its staff that the promotions won't come until June. So it should have come actually, and it will be coming in December. But then essentially saying like, hey, we're holding off on promotions. You won't be told until June. So this is actually quite symptomatic of all the consulting firms, right? Because if the enterprise companies are not spending as much, then they're not.
And I feel like this is kind of a story that we haven't covered as much. And I remember earlier this year there was a lot of talk about the softness in the consulting space and how that ties into corporate spending here. But I feel like we haven't done enough about that.
Well, especially if we're heading into a recession, like this is up for debate right now, right? So how much of a cut do we need? And if it really points to a recession, then that means a lot of companies are going to pull back on some of the expenditure. If they don't have to, obviously some of the areas that you have to do is AI, keeping up with times, right? But some of the other areas, then if you can cut, you can cut. If you cannot cut, well, like the retention of staff, you just tell them, hey, it's coming, but it's not so soon.
All right, Amy and Bailey Lipschultz sticking with us here. Of course, a quick check on yields as we, of course, move into a big Fed decision tomorrow afternoon. Right now, 3.59. We'll just call it 3.6 right now on your 2-year yield. A similar on the 10-year yield. All yields slightly higher on the day, 2 to 4 basis points across the curve here. Meanwhile, of course, as we keep an eye on what's going on in markets with regards to that Fed decision, Bloomberg Business Week, guys, has its latest business school ranking survey. Now, well, I'll just ignore the fact that Chicago Booth School came in number second, snubbed once again here. But at the top of the list, probably not much of a surprise, is Stanford.
The thing that stands out, though, Romain, when you look at the kind of what goes into these rankings, Stanford, the difference between other schools in terms of entrepreneurship, the ranking, is kind of astounding. I guess it fits into the sense that if you go to Stanford, you're in the Silicon Valley, you kind of have access to some of the best and brightest in technology.
And then you become a tech bro and you run the world, right?
You make a lot of money on the way. At least we made some profits before we ended the world, you know?
But that's the thing about these rankings, right? They are based on certain metrics. And we all know that each school specializes in different things, right? So you mentioned Chicago Booth, I think there's Harvard.
Look at that, Northwestern Kellogg made the list, so we're 2-3 there.
There you go.
That's my alma mater there, and I grew up next to Chicago.
Someone needs to cut a check to Stanford, though. I just am saying, you got Booth, Kellogg, Tuck, Darden. Stanford's just Stanford.
So what are you? You're like a Syracuse guy, right?
Some call it the Stanford of Central New York, but...
Amy, do you call that the Stanford of Central New York?
Well, especially when Bailey is there, I want to comment on it. But it's very interesting to actually see where the graduates go, because the top of the list is going into consultancy, which is actually experiencing a pullback. And also, just to highlight this, obviously, like almost 4,000 people actually went into consulting. Out of the graduates, 212 went into media and entertainment.
I saw that. I saw that. It is apparently a good place to ride out a recession, though, business school.
All right, well, there you go. Definitely check out the latest rankings, business school rankings. Stanford, University of Chicago, Booth, Northwestern Kellogg, Dartmouth, and Virginia's Darden rounding out the top 5. Our thanks to Bailey Lipschultz. Our thanks to Amy Orr. Romain Bostic here with Vonnie Quinn. Sticking around, and we will hope you stick with us, too. A lot more coming up here on the big program. Stephen Wieting, interim CIO and chief economist over at Citi Wealth. He's joining the big program after the break. This is Bloomberg.
Welcome back to The Close. I'm Vonnie Quinn.
And I'm Romain Bostic. And get this, Vonnie, a 7th straight day of gains for the S&P 500. But if you squint real hard, it wasn't much of a gain, almost unchanged on the day. But the way the record books work, Vonnie, that is 7 straight days, 56.34 and change. We should point out at one point in the day, the S&P did trade above its all-time high. Of course, was not able to hold that. The repositioning, of course, taking place ahead of the Fed's decision. Of course, we'll have full coverage of that with team surveillance tomorrow afternoon. But you see the outperformance by the Russell 2000. 4th straight day we've seen that as a lot of people really start to bet on the sectors that could benefit most from a significant drop in interest rates over the next few months.
Exactly, and as you say, Romain, we ended the day really pretty much unchanged on the S&P 500. A lot of push and pull today and a lot of trading, much more so than you might have anticipated a day before the FOMC meeting. We did, though, have some big movers, Intel being one of them. If you see, it's up more than 2.7% or so at the close. A drip, drip, drip of positive information out of Intel the last few days has really sent that stock higher, about 11% gain, as we've been saying through the program. They're like the Democrats. They're going to have to keep that going in order for that momentum to continue. Moderna as well, an interesting one, because, of course, you saw that huge drop-off for Moderna just a couple of sessions ago. Excuse me, Canada has now approved its latest COVID-19 vaccine, and that's given that stock a boost today. Microsoft, of course, as well, up almost 1% on that buyback.
All right, well, let's end there on Microsoft, because there actually is some breaking news on Microsoft right now crossing the Bloomberg terminal involving what else? AI. BlackRock and Microsoft teaming up for a $30 billion fund for AI infrastructure. This is coming out of a report from the Financial Times. It's light on details, but what we have learned right now is that they plan an AI fund for infrastructure totaling about $30 billion initially, and NVIDIA will be providing expertise for that fund. We'll try to get you some more details on that as we continue the program, and we continue that program right now with Stephen Wieting. He's the interim CIO and chief economist over at Citi Wealth, and he joins us right now.
Thanks for having me.
As you know, there's a big Fed meeting. You might have heard.
Oh, yeah. Monumental.
Monumental. I do sort of wonder, I mean, we can get into this whole debate about what happens tomorrow.
Right.
What I'm more concerned about is what happens over the ensuing months. The market is pricing in a lot of rate cuts. The market has repositioned around a lot of rate cuts. Are they right?
Well, look. When you take a look at the Fed's summary of economic projections, and it says that the funds rate will be 3.1% 2 years from now, history suggests that they find their way faster. So the market is very much front-loaded that. It is expecting, again, the policy rate to be cut 250 basis points about over the next 12 months. And it's very plausible to us that it's somewhat less than that. And it's not, again, about 25 or 50, as, the world will shake on that one tomorrow. But it's really, again, what are the conditions in the economy? And we do think, again, the labor market is slowing. We're at an unusual time where it's really about neutralizing excessively tight monetary policy, making sure that the labor market doesn't have to slow more than that. But it isn't a collapse in the economy. And when you priced it this aggressively, you have to start thinking again about backing off of that just a little bit.
I am curious about some of the parallels people have drawn to the Greenspan hikes back in 93, 94, and then those rate cuts, I should say, in 95. That was sort of the stick, the soft landing, the holy grail. Jay Powell himself has referenced it in the past, saying that he's modeled it after. And a lot of people are saying that this could be a redux of that.
Well, it isn't all because of the Fed, let's say. It's really, again, about current conditions, how the economy has unfolded since the pandemic. That we have really only been in, 2 really robust years of labor market gains, and yet the economy, if you take a look at housing turnover, it's down about 30% from the pre-pandemic 2019. Wow. When you take a look at the way banks behaved, when you take a look at, deep losses in stocks and bonds, back in 2022, trade and manufacturing have all had these mild recessions rolling through the economy. And that bears a lot of scars of policy traction, that the Fed actually impacted the economy. And so we're seeing many companies now only swerve back from declines in profits to gains in profits. So again, this is different. It's asynchronous. And I think that the Fed has a very good chance of pulling this off, even if it isn't all about them.
Steve, the 2-year yield is not that far off, 200 basis points below the policy rate. Is that a healthy place for the 2-year to be?
It could be accurate, but it shows that there's very little sort of further to gain here. Now, there's been some heavy shorting in the futures markets for bonds, for example, again, with a lot of people, perhaps taking the other side of the trade. And so the pain trade is ever lower rates. But we just have to say, this is a lot of easing priced into the Treasury market. Now, there are other elements of the fixed income markets that don't show that. Why are mortgage rates so far above Treasury yields and at an unusually wide spread? These are things where easing could still come into the marketplace. And then you think about some of what's happened here. We've had a defensive cast in the equity market. The utility sector, for example, has led, but it's an election year. We've done this pretty routinely around election years. And coming out of this, again, we may be still seeing, despite near all-time highs in the S&P, we could still see some distortions in markets right now that really don't tell us that much about the coming year.
Those who have been calling for 50 basis points as opposed to 25 have been saying it very, very loudly and have been basically sort of alarmist, saying, look, there's a problem. We need to go 50 in order to sort of undo the problems that the Fed has created by not cutting sooner. If we don't get the 50, are we potentially in trouble?
Well, I think what's most important is don't use 25 or 50 as the forecast for the economy. And so many people are tempted to. That if the Federal Reserve has decided, we have pre-announced an easing step. We have waited a long time to be quite certain that inflation is going to get a target, and we don't want the economy to slow. We have our next meeting in November. Let's just finally do a little more decisive step. That means that there's an economic collapse happening. Yeah. So again, these sort of descriptive statistics don't take into account what's really going on in the economy right now. So I would want, again, if you think that ultimately that the policy rate should come down to something closer to neutral, if the Fed's a little faster in doing that, good.
I am curious then about market positioning around this. There was an interesting commentary by Savita Subramanian over at Bank of America, one of your competitors, talking about being boring right now is kind of good. And she was kind of making this point, gravitate to, utilities, gravitate to dividend-paying stocks, find where the cash is moving and position yourself around that. Does that sound like they're appropriate?
Well, look, I would say that, high dividend yields, utilities, these things have just run up on pre-election caution. They've run up on this sharp drop that we've seen in yields. We think about the piece that's been left behind here. Across cyclicals and non-cyclicals, high-quality dividend growth companies have just had a deep period of underperformance. And that strategy tends to win out over long periods of time. So if you're uncertain about exactly how we're going to land or what this election outcome is going to give, the mix of Congress and the president, this is a high quality strategy that for this time and this period doesn't look just like it's an overbought utility.
Is it a low volatility strategy?
It's a lower volatility strategy. It's historically less than about 40% vol less than you would see in the NASDAQ 100, for example.
What if oil continues to sort of, drive us crazy, right? I mean, right now at $71 a barrel, it's not too insane, but,
these are such well-worn ranges. I mean, we've had 148, way back, 15 years ago, and, we have seen, oil bleeding out of the ground, at other times. So this is a really kind of a restrained oil price that's remarkable in light of the geopolitical context. And then if you take a look at energy costs across the world and the risks that we had, what's happened with Russia, Ukraine, and the Middle East combined, these are really tremendous supply risks. And yet, again, supply is there, generally speaking, and we're in really well-worn ranges that are not influencing consumer prices.
And unresolved risks, too.
Unresolved risks. Yeah. And again, but it just shows that, again, a pretty well-supplied market, particularly on crude oil. But it's remarkable adaptability for Europe to be paying the same natural gas price with conservation, with new sources, and these are pipelines that are gone from between Russia and Europe.
For sure.
So it really just shows, again, the adaptability of the economy. And that's what I think a lot of people have missed about the broader economy, that given a little bit of time to adapt, we could grow through some pretty good shocks.
Steve, have we put in the high for gold?
Yeah, what about the gold
Have
price?
we put in the high? Is that it now?
Look, I would say that gold right now, I wouldn't want to think of it again as a no-brainer, right? Because the Federal Reserve is easing, because interest rates have already moved down a great deal. What we're seeing again is new sources of demand from China that for us are just not as predictable as the sources we've had in the past. Gold should rally as real interest rates fall. The problem is it rallied when they rose. So we've reached a near all-time high in the real price. Now, again, that would tend to give us an overshoot. Strong performance gets people involved and big overshoot in the market. I think that's possible. But to view that as a low-risk, predictable trade, I wouldn't want to go with that.
All right, I do have to ask you about positioning around the November 5th election here in the U.S. Traditionally, a lot of market strategists say, don't ever trade an election. Always sort of wait till the dust clears and then, startfigure out the policy positions and long-term there. Is this different, though, this time around?
Well, if it's foreign policy, you're stuck with, starkly different contrast. If you're thinking about, the conflicts, if you're thinking about trade, if you're thinking about green energy, it's one or the other. And I don't think we have a great advantage over a lot of the data that comes from prediction markets, from polling data. It's not entirely clear. When it comes to fiscal policy, I think the thing that we have to consider is that, the probability of an absolute clear sweep for red or blue, particularly for blue, does not look so clear, right? Even if you knew the president, you've got to know for fiscal policy that we have a unified Congress that's going to make big changes. And again, that it's going to be a Congress that has such a margin of victory that big tax changes can take place. Yeah. I think we're not heading over a fiscal cliff. I think it's very easy for American politicians to punt on deficits. That isn't the world's biggest concern, but you know what? There's no big constituency out there that really wants a lot of fiscal tightening in the U.S.
That's for sure, although there will be a tax conversation next year, that is also for sure. Steve, thank you so much for joining us, and particularly in studio. That is Stephen Wieting, interim CIO at Citi Wealth. And of course, Steve is absolutely right, Romain, you don't want to be trading the election, but at the same time, the complaints that we're not getting enough detail on economic policies from one side or the other or whatever, they're a little moot given that there's not that much a president solo can do.
Yeah, and it's kind of moot too, because this was one of those elections where people seem to be voting more on personal characters and whether they like the candidates. But I thought his last point, too, about politicians always finding a way to sort of kick the can down the road when it comes to deficits. Like, we care about it until we don't, right? Exactly. And that's the problem. And markets will have to adjust to that.
Well, and we care about it until people stop buying the debt. And they're not stopping anytime soon.
Absolutely.
All right. Yeah, exactly. Coming up later this hour, the Property Brothers embarking on a new venture. They join us to discuss. You don't want to miss it. This is Bloomberg.
All right, it's time now for our top three, where we name drop the people driving some of the day's most talked about stories. And we start off with Joshua Schulman. He's the CEO over at Burberry. He just took over in July, but he was speaking just recently at the first London Fashion Week show since he took over. And he says he really wants to elevate the Burberry brand. Of course, we all know it for those plaid checks there. But he kind of felt that maybe it went a little down market for a while, and he's trying to bring it back up just a little bit.
Yeah, I think that we need some Burberry for you, Romaine. I think that would be the perfect look.
I can't fit in Burberry. It's all like it's very slim cut. I don't have a body.
I think that you would. Yeah, it would just suit you down to the ground. Yourself, Jason Statham. You know, the whole Burberry.
Jason Statham, of course, is also has an Adonis body. Farrell wears only Burberry here.
Is that true?
I think that's in his contract. He can only have Burberry. He's difficult.
Well, I'm watching Brian Nickel, Starbucks' new CEO, looking for a global brand czar to help revive the coffee chain's sales. It's not a terrible idea. Who would you imagine that he might put in that role, given that he probably has endless money to spend?
Yeah, it's interesting, too, who they pick here, because, he gave some comments the other day about how he wanted to make Starbucks more of a coffee shop. I don't know if you've been on one lately, but it's basically just like a takeout joint now.
Yeah.
There's nowhere to sit. It's just, it's just a different experience than what I remember a few years ago, and he seems to really want to bring that back, and maybe having a global brand ambassador who can really sort of, just cultivate an image for this company that I guess he thinks is going to be profitable. It'll be interesting to see how he can pull that off.
Yeah, I just do wonder who is a good coffee czar,
Who is a good coffee czar?
Because a lot of celebrities have alcohol drinks now, or, specifically non-alcoholic drinks, right? But who says coffee to you? Rihanna?
Rihanna? I don't know. That's a good one. All right. I'm also keeping an eye on Michael Jordan, the basketball player.
Yeah.
The basketball legend has been trying to offload his Chicago mansion for years. It was originally listed for about $30 million. They cut the price at one point down to around $15 million. Now we finally learned he finally sold it. Vonnie, were you the buyer?
I was unfortunately not, because who doesn't want a basketball court in their house, an indoor basketball court? Along with a cigar room, obviously.
Well, cigar room. That's the thing about these houses that these people do. They create them, and they're so customized to their personality
they don't need to leave.
and their lifestyles that when they try to sell it, nobody else really wants it, because it's like, well, I just got to rip everything out to make it work.
But I don't think he really cared that it was still on the market. He's in Jupiter, Florida, playing golf, and thinking back on his career.
I don't know. I feel like he cares about it. He's kind of a vindictive guy. Have you ever talked to him?
I watched the series. No, I haven't talked to him. Is he vindictive? Tell us more.
What? Did you not see that series? That guy can hold a grudge. I don't know. I think he might hold a grudge against his real estate.
I think he was mindful. He was being mindful.
All right. Well, good for Michael Jordan. He's got a few million. We don't know what the actual sales price was, but he's got a few extra $1 million in his pockets to keep him, tide him over here. When we come back, we're going to take a look back in history, Bonnie Quinn, and the historic run on money market funds in the wake of the Lehman Brothers collapse. That's coming up next, right here on The Close. This is Bloomberg. All right, let's take a look back in history to 16 years ago, when a two-day, $200 billion run on money market funds began on September 17, 2008. It started when the Reserve Primary Fund, the OG money market product created in 1970, broke the buck. And admission its shares were no longer worth $1 as promised. This after its holding of debt plunged in value when Lehman Brothers collapsed just a couple of days earlier. That triggered widespread panic among investors and other funds, with industry-wide redemptions averaging about $100 billion per day on September 17th and 18th alone, according to the New York Fed. And all told, around $310 billion, or around 15% of total assets, were pulled that week, according to the Government Accountability Office. That compared to just $7 billion in withdrawals the entire week prior. That stunning reverse tsunami forced money funds, the largest collective buyer of unsecured short-term loans known as commercial paper, to stop purchasing them and start selling them, shutting off corporate cash flow and freezing credit markets. We know what happened. The run on the bank, if you will, only abated after the U.S. Treasury and the Fed stepped in. Remember, money market funds back then were considered among the safest investments, but key to that perception was being able to keep the fund share price fixed at $1. That was known as constant net asset value. Think of it this way. $1 deposited in a bank is always worth $1. You know that. But $1 in a money market mutual fund is buying a share of a pool of loans made by the fund, and those loans, the value of which can go up or down. In the wake of that panic, the SEC in 2014 passed rules aimed at protecting investors, but those rules were tested once again during the pandemic when investors did another run, yanking $125 billion out in March of 2020 alone. That led to another infusion of capital from the Fed and another round of regulations for the industry. Regulations that largely take effect next month, and it couldn't come at a sooner time. A record $6.3 trillion in cash is sitting in money market funds right now. That's triple the assets held back in 2008, and JP Morgan expects that to grow by the end of the year, even as the Fed starts to cut interest rates. Bonnie?
You may know the Property Brothers from their popular reality TV series. Well, now the Canadian siblings are embarking on a new venture to invest in entrepreneurs making moves in the housing industry. They're partnering up with Groundbreak Ventures to launch something called the Healthy Home Innovation Fund. The fund hopes to back companies finding innovative solutions that prioritize sustainability, affordability, adaptivity, and connectivity in the market. Joining us now for more are the property, but that's a lot of activities. The property brothers themselves, Drew and Jonathan Scott, co-founders of Scott Brothers Global. So tell us about these activities, Drew and Jonathan. What do people want, and how do you give it to them cost effectively?
Well, I think the biggest thing is we're in a period right now where there's so much incredible innovation that is going to transform not only how our homes operate, how we, secure our homes, and also the transacting within a home, whether you're renovating, buying, selling. So we're looking for from Series to Series A right down to seed. We're looking for any companies that are providing a service or a technology that we think we can get behind and amplify. And that's why we've got a lot of interest from investors who are coming in as well, saying we know there's something here that's got a lot of opportunity to grow, and we're just trying to find something unique that nobody else has touched on yet.
Yeah, the main thing actually is we're looking to raise $85 million, and that's just to be able to purchase and renovate Michael Jordan's house. That was the main reason for the fund. No, aside from that. I think, like John was saying, for us, we've always put family first, and we're really interested in finding ways to make homes more affordable, have the home work for people instead of them having to work so hard to afford to live where they are. So whether we're looking at sustainability or adaptivity or connectivity, there's so many ways for us to bring new innovation to the market and then utilize our face and our brand, which is a household name when it comes to home renovation design, to really help these new companies scale up. And I'm excited. This is a new venture for us. That's why we look for the best of the best partners with Groundbreak.
For sure, for sure. Well, you're looking to raise $85 million and put that to work. And I mean, there must be so many candidates out there working on solutions for the home, for example, and not just the big players that we all know. Why would they, not to be, rude, but why would they need seed money at this point if it's something that can generate money on its own?
Yeah, well, again, we're looking for, there's a lot of new innovation out there that just hasn't seen the light of day, or even looking at geothermal as an example, it's not cost effective right now. So there's a lot that is technology, a lot that's sustainably based, or, looking at net zero construction that doesn't have the money to grow. And so we are looking at our strategic partnerships as well with our fund and LPs, whether it's insurance, banking, developers, builders, you name it, to be a part of this, because this is something that can help their businesses thrive as well.
What's interesting as well is we have a situation unlike anyone else out there where we're in people's living rooms across the country in 80+ million homes a year with our shows, and we get feedback, real-time feedback from all of our audience. Drew and I receive 500,000 messages a week each from fans saying, here's what I need at home. Here are the problems we're encountering. I wish there was a solution for that. In the same boat, we have technology companies, engineers who've created technologies reach out to us as a first step before they've even gone to look for funding because they have an idea. So we really get an inside scoop as to where trends are going when it comes to the home space. And we've had a lot of incredible partners as well who have brought us companies where they think they see the opportunity for us to amplify the message and the product that they have in a way that they couldn't do if they just went to the open market.
So Jonathan, on that point, and first of all, thank you for one of you shaving so I can tell you two apart. But Jonathan, on that point, when we talk about sort of what people are looking to do for their community, obviously, I'm sure affordable housing or more affordable housing is a big issue in a lot of markets, certainly out there in California where you guys are based here. Some of the ideas that you're expecting to generate, or maybe some of the ideas you've already gotten, are they targeting that as well? Is that something specific?
100%. So one of the companies that we've acquired is a company focused solely on ADU construction and multifamily construction to offset the housing crisis. What we see out there, and Drew and I are both the same. We're total data nerds. We dig in and we want to find out what's causing the problem and what's a realistic solution. Most of the offerings out there are total crap. Either the product is going to fall apart, they're overcharging, and a lot of communities really want to spend to find a solution for the housing crisis. So we're trying to dig in and find out what's going to be good for business, what's going to be good for communities, but ultimately what's going to actually solve the problem, because we've been waiting too long for someone to actually do something that's going to be effective.
On that point,
you look here in California, one issue here is the cost, even if you're looking for housing, trying to help people off the street, just a very basic, small single room, bedroom unit, the cost is over $800,000. That's something that we're cracking. The housing crisis is a massive issue all across North America. And so that is one of our verticals to really strongly focus. And we have strong relationships, whether it's federal, state, or regional here, to help work on that specifically. So I'm excited, again, with this panelized system that can come into a new way of building your home at an affordable rate that's still a solid home. It's not something that feels cheap, thin walls. It's a real home, but it can bring that price point way down.
I am curious, then, Drew, on that point, and this is a broader question just about kind of the state of the home building market, home renovation market, if you will. We saw prices really get distorted because of the pandemic, prices for supplies, that is. Has that kind of right-sized itself? I mean, is it, I guess, more normalized than what we saw prior to the pandemic?
I guess it depends what you're looking at for your materials. In some ways it's normalized. Its timelines are the thing, too. The timelines were ridiculous for, even just ordering windows. Our timeline was 10 times longer than what it used to take. It's not just that, though, which you're well aware. The cost of debt is so high as well, and it's so hard for a family to look at getting a home or renovating a home, because when you have expensive materials, long time delays, and you have expensive debt, it's just a losing recipe. So
we're seeing a lot of the delays coming from labor shortages as well. There's just too much work happening and not enough people that can sustain the workforce. So we're going to see, and we've already started to see, a real surge in the trades as well. People can come out of college and be making a six-figure salary right off the bat. And so I think that's a huge thing too, balancing the jobs out there with the technologies that are coming in to make life a little healthier at home.
Jonathan, what are the small things that people are starting to look for, the newer things? I mean, it used to be that the kitchen was all important, or that extra bathroom, or that rainforest shower. What are the next things that we will be wanting in our homes?
Yeah,
Romain's laughing at me. Everyone likes a rainforest shower.
I guess. I don't know.
Rainforest or rainfall?
I mean, it reminds me of a rainforest without the bugs.
Technology is everything, but what we're noticing is there's going to be a real shift toward things like leak detection and AI-driven leak detection, because water is getting more expensive. The quality of air and water at home is going to be incredibly important, as well as homes are moving toward an electrified system. It's much more efficient, and the data that comes off of that as well can preemptively catch anything like an appliance breaking down, or something that could cause you a more expensive problem. So technologies like smart electrical panels, leak detection, these are all things that are really, really high on our radar, because they're actually going to help people in their budgets at home, but they're also going to make life easier.
And on top of that, for example, battery walls at home, solar is amazing, and people are shifting, and regulation is also making people shift away from gas. But if you don't have battery backup, you're really missing out on a lot of opportunity to offset your costs at home and protect your family. So there's so much to be excited about. I would definitely say that's another reason we're excited to start allocating funds from our fund.
Yeah, and this is a great idea, and I'm just looking through kind of all these materials and preparing for this, and I really wish you guys the best. I do kind of want to end on a lighter note. You were joking a little bit earlier, Drew, about the Michael Jordan property. I don't even know how many square feet that is.
32,000.
You can build a lot of affordable homes just out of that property. But I mean, for those of us who've watched you and seen you guys, tear up these homes and turn them into something better, how do you deal with a home that is constructed so specifically to one person's taste, and then have to put that home back on the market and make it, I guess, palatable to someone else, or to the masses, if you will?
It's the one thing we tell clients all the time. For 20 years working with clients, we've been saying the same thing. It's great if you have something you personally really love, but you always have to think as though you may have to sell this house. What if your family grows and you need a bigger home? Or what if your job transfers you to a different city? Always think of what if you had to move. So that secret man cave that you want, and the secret panel in your wall, or the basketball court in the basement, I always bug my friend Michael Bublé because he dug out his basement and put in a full hockey rink in his basement. He will never see that value back again. But it's up to them. If somebody wants to possibly throw that money away, Michael Jordan makes enough to be able to be okay to walk away from a few million. It's a decision you have to make.
An easy way to remember is we always tell people, the more bold you go with an idea in design at home or in construction, the more bold you go, the faster it's going to go out of style. Yeah. And so just be prepared that you're going to have to spend on it again.
Yeah.
A full basketball court in the basement is pretty bold.
Yeah, and absolutely.
Great wooden floors, though.
Yeah, absolutely.
I
guess if you have their kind of money, I guess it doesn't matter here. Why not put a hockey rink in your basement or a basketball court? Maybe one day I'll get there. Hey, thanks to both of you guys. Really appreciate you joining us. Drew and Jonathan Scott, of course, the co-founders of Scott Brothers Global, of course, HGTV stars as well. All right, meanwhile, back here on The Close, we are taking a closer look at markets as a lot of people are repositioning around that big Fed decision expected to drop at 2 p.m. Washington time tomorrow. But the price action here, I think, was really reflective of how a lot of people not quite sure what the Fed is going to do. 25 basis points, 50 basis points, maybe even more. An S&P 500 that at one point did trade above its record high of 56.67, though could not hold that, closing back down around that 56.35 level, unchanged on the day, but it's the outperformance of the Russell 2000. It's the jump that you saw in yields, particularly on the short end of the curve. It's the bid that you saw come into oil and some of the other cyclical spaces. That is the market story for today, and it could potentially be the market story tomorrow. We'll be back in a moment. This is Bloomberg. With all eyes on the FOMC decision tomorrow, JP Morgan CEO Jamie Dimon saying that the Fed will cut rates, but it won't be earth-shattering. Also saying geopolitics dwarfs any other concern throughout his career. He's speaking right now at the 2024 Financial Markets Quality Conference hosted by Georgetown University in Washington, D.C. Let's take a listen.
To be in the cabinet, because the real world, it's a tough place. It ain't this hypothetical thing. A great quote, in theory, practice, in theory, the same. In practice, they're not. You try to conduct business out there. It's much tougher than people think. And so look at all the ideas, analyze all the things, come with a good policy, and try to get out there. Acknowledge our flaws. I mean, honestly, this geopolitical stuff is number one. And our flaws have hurt a lot of people. So take our own country. I just want to mention this before we go to a Q&A with the audience, that if you look at what we've done, we have the most prosperous nation on the planet, but we grew at 2% a year for 20 years. Did anyone ever tell you what it should have been? It should have been 3, maybe more. That 1% difference would have been $15,000 per person a year this year. So cumulative wealth, it would have been $40,000 or something like that. And that's a huge difference. You want to pay for making it a better country and childcare and stuff like that. And we still don't aspire and say, what is it we're trying to do and what policies didn't work? Well, here's the policies that didn't work. Mortgage, affordable housing, veterans, FAA, the IRS, and I can go on and on about the infrastructure, permitting. We have some climate policies which have the exact opposite of what people expect them to have, cause more CO2. We better have affordable, safe, and secure energy. Otherwise, CO2 will go up overseas, which you saw if you were paying attention to data, which you saw during the very expensive winter right after the Ukraine war. And who gets hurt the most by these policies? The poor, the lower 20%. As I always find, why can't Democrats and Republicans acknowledge that? Years of flawed policies, and the poor always get hurt. Always. So it's not us, and most of us don't drive through dangerous parts of the neighborhood, didn't send our kids to some of you might have gone to some of those tougher schools, but I mean, I find it quite disappointing that we're not facing these issues, dealing with them, and then, in a mature way, let's attack them. And I also wrote in there, and it was surprising to me, Eisenhower and I think Clinton and a bunch of folks, they had the opposition over all the time for breakfast, lunch, and dinner. That stopped, at one point, and I think that's wrong. I think if you're a Democrat, you should have the Republican leadership over all the time. Ask them how they're doing. Ask about their families. Ask them, is there a way we can find common ground and this or that, and vice versa. And I think you make it a better society by having a beer with someone and trying to understand and respect where they're coming from. And America should stop lecturing other countries all the time. We should push them, help them become better, but we should not lecture them about how to handle every instance in their country. We're hurting our ability. We're like the Americans, and then we do things like that just are not in their interest that we didn't even think about.
I could ask you lots of questions about Basel III, about the debt,
God,
about
don't
private
do that.
credit.
You'll bore even me.
But I'll ask you a more important question that's very relevant for our students here. They're going to live to celebrate their 100th birthday, right? Pretty much everyone here, the students here. What advice do you have for them in this very long life that they're going to lead?
I'm hoping before you hit 100, Basel III is completed. I mean, it's been going on for 10 years. I would have gotten it done in 6 months. I find it unbelievable. And then the press writes for or against. Forget that. The work should be done that justifies what they want to do with the cost-benefit study, and it didn't happen. So, I tell people, it's like the banks want relief. I don't care about relief. I want the work to be done properly. That's it. An honest assessment. And even after that, they can say 10% more capital would be fine with me. And so, but advice to students, learn. If you're a Democrat, read the Republican opinion, the good ones. There are a lot of good, very smart ones there. If you're a Republican, read the Democrat ones. Read history books. You can't make it up. Okay? You can't make it up what people had to deal with when Nelson Mandela, Abe Lincoln, Sam Walton. You only learn by reading and talking to other people. There's no other way yet. Maybe one day they'll be able to inject knowledge into your brain directly or something like that. Be smart about it. People waste a tremendous amount of time. For most of you guys, turn off TikTok, Facebook. Total stupid waste of shit. Waste of time. And look at all the facts. Get to know all the people. Develop your EQ. Like communicate well, listen, you want to be the person who walks in the room that people, they want to hear you have to say, because they know you did your homework, you're not wasting time, you're not like just starting to talk, you all see people, they walk in the room, they start talking, people, oh God, and here they go again. Be flexible, don't allow yourself to be weaponized. And when people come with binary arguments, they're usually not. So if you do it to me, the second you do it to me, I'm saying, excuse me, don't do that. It's not either or, it's never that, it's usually something in between. You get smarter over time. Learn how to act. A lot of people don't. They talk, but learn how to take a decision, and then have a little courage and a little grit to go behind it. And something they don't really teach you in business school, but they should. I think the most important things are curiosity, which is the learning part. It's also a form of humility. You don't know. I didn't know that. Even when I go to any branch of J.P. Morgan Chase and sit down with the teller, and she will he will teach me things I don't know. And the show says, say, if you're honest with them, like we go on bus trips and we give them beer and humidity and they'll say, why do we do it this way? And you look at it and say, oh God, that is pretty stupid. Like, why did we do it that way? And that's how you learn. You get out, see people, go to different countries. I send people to different countries, look at the technology they're building, things like that. And but the other word is heart. Treat people with respect. Treat people with decency. Whether people are disabled or very smart or second chance citizens or veterans or LGBT or just a very shy human being on the autistic scale, treat them with respect. And learn that everyone can contribute, and those should be values that transcend everything. And even in a company, people expect companies to be heartless.
And that was the always straight-talking Jamie Dimon speaking there at the 2024 Financial Markets Quality Conference, hosted by Georgetown University. Joining us now is Bloomberg senior reporter covering Wall Street, Sridhar Natarajan. Sridhar, he said a lot just in those couple of minutes, but I have to ask you about Basel III. He'd have got it done in 6 months, really? It's taken 10 years, and he thinks he'd have got, would he?
The most amazing thing is while most other bank CEOs, if they don't like a piece of regulation, they'll go out there and say, look, we're a little uncomfortable with this, let's have a dialogue. Only Jamie Dimon can go out there and say, it's asinine. And even though he's saying he could have got it done in 6 months, he probably could have, but he would have had his way. And I'm not sure that's what regulators want. So it's dragged out for 10 years, which seems crazy in itself. And we're no closer to a resolution.
No closer to a resolution. Maybe it gets done in the 100-year lifetime of those kids that he's talking to here. It gets to a point, too. I mean, he talked about a lot of wide-ranging issues. I thought it was interesting, his commentary about geopolitics being probably the biggest issue, at least in his career, that he's seen.
Look, when Jamie Dimon goes down to Washington, Jamie, the financier, turns into Jamie, the statesman, even if he turns up there in jeans. And, in a way, he's earned it. He is the dean of Wall Street CEOs. He's been CEO of the country's largest bank since the time George Bush was in the White House.
I know. Did he talk about succession planning at this event at all?
So far, he's avoided that. I'm sure they'll get to that.
Because I think some of the kids in the room would like his job.
But he had pretty strong words on geopolitics. He was very clear that is the most important issue. And if it does not end up going down right, it could have significant impact on markets as well. And he talked about the idea of what's happening in the war on Ukraine, what's happening in the Middle East, what's happening with China, particularly harsh words for China. He talked about the fact that that economy is in reverse gear. They have done some things that have not gone down well, and they have crushed innovation recently, which has been a topic of discussion. What he didn't seem overly fussed about is what the Fed is going to do tomorrow.
Not at all.
Whether it's going to be a 25 basis point cut or a half-point cut, he says it's irrelevant. It's a minor thing.
Earth-shattering. Yeah, amazing comments from him. That, you know, for his business, it's a little bit true. Eventually, it'll be earth-shattering. This sounded a little bit like, you know, perhaps a pitch for Treasury Secretary?
Well, since he's been CEO, it has long been rumored, would Jamie Dimon be Treasury Secretary? Would he ever be picked? It has never seemed really likely. He's never been at the 5-yard line, and I don't see anything on the horizon that necessarily changes that, even though every time there's an election that comes around, there's always the talk of would Jamie be Treasury Secretary? And also sometimes, would Jamie run for president? There is one thing he did talk about. He talked about the lack of unity in Washington, the need to talk to opposition leaders. And there was one message that I particularly liked, which was his message to the students at Georgetown was, go have a beer with someone. If that's going to be his campaign stump speech, I think we can all get behind Jamie for president.
Better op-eds.
Yeah, all right. Well, I hate to bring it up. He is 68 years old. We just had a whole debate here about presidential candidates being too old, but good for Jamie Dimon and good for Sridhar Natarajan, Bloomberg reporter here. Of course, you can continue watching that on Live Go on the Bloomberg terminal. Meanwhile, as we wrap up the show, let's push ahead to some of the potential market-moving events over the next 24 hours. And we start off tomorrow morning with earnings, Vani. They never stop.
General Mills coming out tomorrow, and the late, great Ken Pruitt used to always make me wonder, what was the company that produced the Lucky Charms going to report? He made me say it every single quarter.
Yeah. All right. Well, it's certainly maybe potentially a read on the consumer health of the consumer staples. And I don't know, maybe there's an Ozempic angle in there that we'll want to hit here. We're also going to get maybe some news out of tech executives. Meta, Alphabet, Microsoft apparently are going down to Washington tomorrow.
Yeah, they're going to be speaking to the Senate about their role in combating foreign threats in the 2024 election. I imagine we're not going to hear too much that we haven't heard already, Romaine. There won't be anything earth-shattering for sure in those testimonies, but we will keep an ear out just in case.
All right, let's get to the nitty-gritty economic data, 8:30 a.m. tomorrow, Vani.
Yeah, we're going to get mortgage applications, building permits, housing starts, a lot more information about the housing part of the economy, but of course, all of everybody who responded to those surveys, they're only going to be listening for what the Fed says
2 p.m., of course, is the big event tomorrow. That is when we get the Fed's statement here, whether they cut rates by 25 or 50 or maybe not at all. 2:30 p.m., Jay Powell takes the stage for his press conference. Full coverage starts at 1:30 p.m. Eastern time with our team surveillance crew. And of course, we will be back here on the close for the market reaction to that Fed decision. But stick around tonight. You'll get the political version of what could potentially happen. Balance of Power. It's coming up next on Bloomberg.